Welcome back, everyone. Happy Monday. Hey, so we're having a bit of a violent open in equities. So let's talk about that a little bit. Let's see what's going on. Grab the NQ chart. So NQ has been just falling overnight, and this is why some people in the chat are saying, "Oh, be careful because it's trading down almost 7%," and it's not that surprising because we've had some very bad numbers that have been coming out, and the Fed has so far refused to make any adjustments, and they keep sticking to the same sort of narrative. But now we've had Bank of England that cut their rates by a quarter of basis points. And now ECB is talking about cutting rates. So now it's like, well, there's going to be pressure on the Fed to do the same. Are we at the beginning stages of the recession? This is why this is happening. So we have to take in this extra volatility into consideration. And so Savage San says, oh, violent crash to violent recovery. That's usually how it goes. Crash is just completely just down, down, down. So this is why I would be a bit careful today with all these ranges. I mean, we're already way past the average daily and session ranges in NQ. So if you must get involved, go down to micros, please. 2 micros should be plenty. Be on the lookout of the risk team potentially putting some restrictions as well on trading, because in the past when we've had these kind of moves, Topstep did have a limit to like how much you can trade if something has fallen to within like 2% of limit up or limit down. So just size down, be safe. Just because there's a ton of movement doesn't always mean that there's a ton of opportunity as well. It could be that it's just a lot of increased risk. So that's the equity side. Now, looking at gold has been traditionally something that is very sensitive to any possibility of recession or any kind of geopolitical risks. However, in recent years, that correlation has somewhat broken down. So it's not as crazy. Like, we did see a jump off a cliff on Friday post NFP, and that kind of happened right from the weekly supply on this new December contract. So if I go down to a very large time frame, you will see that it tried to go all the way up, and then we just smacked back down very hard. And it was a super violent move. It was quite crazy. Unfortunately, my brackets on my live account were not working for some reason. So it just kind of sliced through what was supposed to be a trailed stop, and it just didn't trigger. So unfortunately, it was a daily loss limit for me on Friday. Because of that. So, but even so, this move would have caused some slippage anyway, because it was so quick, so violent. That's the only move that I actually saw that kind of told me that there could be some trouble coming. Whenever gold reacts so violently, there is something brewing. And we had terrible NFP numbers. So why do I say that? Well, for a country that's the size of the US, to only have 114k jobs added, it's absolutely abysmal. So that means, and it's one of the leading indicators, so that means that the economy is not doing as well as they're expecting it to do. Plus, we've had the unemployment that went up, so that's also not good. So slowly we have all of these things mounting, and that's going to add pressure on the markets and everything else to make some sort of adjustments, right? And they haven't done that. So naturally, traders are now starting to price in a rate cut, but it hasn't happened yet. So is it going to be the case of sell the rumor, buy the news? I don't know. Remains to be seen. I might be looking at gold today, but even though we have a slightly larger volatility day this morning, it's nowhere near as crazy as NQ. Even ES, I think, is down about 2.5%, which is unusual. But again, not, it's not unheard of. So let's have a look at ES. Still a violent move down, some recovery, but now it's kind of attempting to fail the auction as well. Is that more downside? Potentially. One thing that I look out for whenever we have these massive days is whether we are overshooting past all statistical averages or not. And then if yes, I'm only looking to the TPO profile to see how strong the auction is or how weak it is. So right now, if I compare ES versus NQ, this upside auction is not that strong. So NQ is slightly stronger because it left a couple of single prints behind. But for now, this correction during London is actually a weaker auction. So it's not, terrible. But it's still hanging, above the initial balance. Both of them are. Now, if we look at DAX, just to kind of glance over to Europe, because, we've had some developments in Bank of England and ECB. So they are talking about rate cuts. I mean, DAX is failing its auction. So that's already failed the auction, so that might be a trade for me. I know we don't have it yet in Topstep. It is coming, so patience. But yeah, for now, DAX looks the weakest out of all of them. It's gonna be an interesting day today for sure. I looked at copper, which was my chosen thing for London. Don't think copper is gonna be that responsive to things. If you were gonna be looking at metals, gold should be the most sensitive metal out of all of them, because gold is traditionally used as a protection from inflation, protection from various geopolitical uncertainties and events. And even though there's no negative correlation between equities and gold anymore, which was the case probably about 10 years ago, there's still opportunity there. And if that's the case, I would be looking at long gold potentially. But it is Monday. We have a crazy start to the week. This is kind of reminiscent to me of COVID times, because this is how it started with COVID. We had these crazy limit down and limit up days, well, mainly limit down, but it just started with these crazy overnight moves. So you would come to trade and already everything would be screwed. Like you'd have no levels anymore. So what I used to do during those times is to just see how the auction is doing. This is where the real time look into what the auction is doing in real time is very, very useful. So, looking at failed auctions, looking at whether it's a neutral day or not, whether the auction is strong, whether it's leaving single prints. And one of the ways to limit risk when you do have a single print, so let me bring up Dow, because I actually did trade Dow in one of my personal accounts on Friday. And it was, where did that go? It was a classic sort of single print trending move down. So I'm going to use my Blatic backtest time machine to go back. All right, so I was expecting that the market was like jumping off a cliff yet again. We moved far away from the value area immediately in the second half hour. And just by the fact that we didn't have a gap fill, because we opened with a gap down, usually when we're not too far away from the value area, you get that gap fill. We didn't get that. So I was looking at this big jump off a cliff, and then I thought to myself, well, if we break the initial balance, we have some chance of reaching this 4-hour zone. So this is a demand zone that I was looking at for target. So I actually entered after the break, and I only use a 55 tick stop, which is pretty small on YM because we have like 483 average session range, which is, it's a decent amount of movement, not super crazy, but very decent. And then I just expected it to stay below the initial balance. So that's how I managed to limit my risk. I used the initial balance as my reference point, and then I just looked for the creation of single prints. I got that, and I even got my full target. But if you're already getting involved, like let's say we have a day like the previous day, Thursday, and if you're running a bit late and you see the market is already outside of the initial balance and already created single prints, what you can do there is to wait for the next open and then to use that overlap of the two candles. You can see that it creates sort of like a little shoulder, a little edge here. You can use that as your risk limiter, right? So that's a very good way to get involved in these moves. And of course, if it goes into single print fade, well, then it doesn't matter. Then in that case, you go back to the initial balance as your level of reference for limiting risk, and so forth, so on and so forth. So that's the whole point of situational awareness. Rather than going, oh, it smacked me on the face, now what? You should always have some ways to limit your risk. Now, obviously, since we are expecting the week to be pretty crazy, today I don't think we have many things on the calendar to act as a catalyst, but we already have the overnight moves and the possibility of a rate cut within like a week. So everybody's pricing in this expectation that the Fed is going to come out with an unexpected rate cut. And that's going to if that's the case, it's going to send the markets completely insane. So, yeah, to be very careful. So the whole, the whole calendar is pretty light. We have the ISM services, we have some PMI, but apart from that, like not much else. So in about 20 minutes or so, we do have the PPI from Euro. So we're going to see how DAX behaves. I don't want to really do anything with DAX before that happens. So yeah, if you have any questions about this, how to navigate a potentially turbulent markets, throw them in the chat. Because it's going to be pretty interesting. This is the week to start journaling as well. If you haven't journaled yet, maybe consider running a journal throughout the potentially turbulent times, because it can teach you some valuable experience of how to navigate the markets, how successful you were. Was there any way to navigate them? And like I said, I've just given you a couple of options to grapple with the higher volatility day where all of your levels are just completely gone. So there is a way. This is the beauty of market profile. This is the reason why I use it heavily. So you can use supply and demand, you can use ICT, you can use a whole bunch of stuff. But market profile, when it comes to real-time lens into the market, it's unparalleled to me, because you can very simply see what is happening with the auction process, very simply, right? If Fed cuts now, do you expect a down or an up move? Well, it really depends on the focus. You see that the rate cut traditionally should be, it really depends whether they are planning to run some kind of a QE program. It's not as simple as, or do you expect it to go up or down? There's so many other things that go into that. Like, for example, when the rates were at zero or near zero, when we had like 0.25 or interest rates, everything was going up. Why? Because that was seen as a good thing, and also because they were running a fairly aggressive QE program alongside of it that was pumping sort of fake money into the market. I mean, it was real money, but it was never meant to stay in it was supposed to trickle down to the consumer. Now that never happened. So what happened is that they kept pumping out QE for the companies, and the companies just kept stashing that money for rainy days. Like, I don't know what rainy days, like we already had rainy days, so it's like, what are you doing? But yeah, so it was kind of successful, but what they didn't expect is that it was going to have such a positive impact on the equities. It was never supposed to do that, not to that degree anyway. And unfortunately, super low interest rates, yet the markets were just going massively higher because that's how it was perceived. So I can't say I expect it to go this way or that way. I'm not here to predict the markets. I'm not an analyst that manages long-term portfolios for people. I'm an intraday trader who holds their positions anywhere from like 45 minutes up to 2 hours. So I don't know how it's going to be perceived, and I never go into a trading day with a bias. So whether it's perceived as a positive move or a negative move, that remains to be seen, right? But either way, as intraday traders, we can't just be biased to one side. That's usually not a good way to be. So you have to have a story for both sides of the picture. So one hypo for longs, one for shorts, and then look for evidence of either of those to confirm or invalidate your trading idea. So it's not about predicting things. It's about what is happening right now and how do we take advantage of it. Brian D says, hi, what do you think of the Nikkei worst drop since 87 today? Well, it is certainly following the rest of the equities. That's probably a question for Dakota, more for me, because I don't think I've ever traded Nikkei. That's not one of my markets. So maybe next time, this evening he's going to be on. So that's a very good question for him. But yeah, I mean, it's something's brewing. Let's put it that way. The big worry is that we're going to have the recession looming. So I think that's why all of the equities across the world are reacting in a similar way. Delta on ES is approximately 36K negative. If and when these shorts fold, we can see a monster rally. Your thoughts, Dave? Yeah, that's definitely possible. But at the same time, those sorts of rallies are typically into the market close. So negative delta doesn't necessarily have to mean a short squeeze is going to come during the active trading hours in the beginning of market open or first 2 hours. In fact, a lot of the times, so let's take a statistic that in equities, the most amount of trades are being done within the last 2 minutes of electronic trading. So when we take that little piece of statistics into consideration, it stands to reason that even if the day has been short, like Delta has been short all day long, you may not see a reaction when those shorts get trapped until they have to definitely bail into the end of the market. I've seen days where Delta was positive all day and yet the market drops like 3%. And vice versa, where Delta is congruent with the movement that they're getting, so it's short. So it doesn't have to be that good of an indication of a short squeeze incoming. Is there a possibility of a gap fill or some sort of a attempt at a gap fill? Absolutely, because if the market participants find that they cannot get paid at the levels and they can't find business further down, they will go into a correction. It is just the nature of market mechanics. It is not magic. It's not them manipulating things. It's not all the conspiracy theories. It's just the function of the market. When the market gets too short, people can't get paid. They have to sell, right? And when they effectively bail out of their short positions, what happens then? Well, those are all new buys that are coming in, right? Because in order to sell a short position, to get out of a short position, is a better way to put it, is to run an opposite order to get out. So it's a buy order to kill your short position. Always think about that. So that's why the short squeezes happen. And that's why if they cannot get what they're after, if they cannot get further movement, it will reverse. So if you know how to keep a pulse on that, you can see them coming in. Usually better on like Bookmap and stuff, because you can see some of that real-time order flow coming in. But even without the Bookmap, you can still see a violent reversal that has, usually on low time frames, you have these like much bigger candles that eclipse and engulf all of the previous candles. That's usually a sign of some kind of a ping back in the other direction. So like a rubber band, elastic band that's pulling the price in the opposite direction because there's nobody else there to take the orders. Dee, are you an economist by training? No, I was a musician by training. However, I have had some qualifications that required a similar qualification to what we're doing here, so Series 3, but in the UK that's called the Level 4 RDR compliant, like whatever. So I do know a lot about it. I briefly worked for I suppose they were a cross between kind of like an asset management and prop trading firm. So I had to effectively find out a lot about the fundamentals of the market, options, futures, all sorts of derivatives, and then also regulations and compliance. So this is why I know a lot about it, and I've also been in the industry now for 16 years, 11 out of those as a prop trader. So obviously you develop, you obviously, I'm not just a trader, you have to know the market mechanics and how it all operates, how the clearing firms operate. So it's not just sit down and click buttons. We need to have that slight extra knowledge about how the markets are actually designed and how they function. But no, I'm not an economist. I actually have two music degrees, not just one, but two. I have one which is music performance, and another one which is commercial music production. So yeah, I was a sax player and a guitarist for 20 years, from 1994 all the way up to about 2014. And then for the first few years of my prop career, I kind of ran two careers simultaneously, and then that became a little bit labor intensive, and then I decided to fold the music career completely. Short life hack. What instrument? Well, some of the instruments that are my favorites and my main ones. So the music performance classical stuff that I did was flute, but then I never used that professionally. So I was a sax player, alto sax, and electric guitar. And I also did like singing and stuff and backing vocals and all that, but it wasn't my favorite. I think my prime thing was being able to speak to people through like solos and stuff, so without words. J-Hook says, Dee, CL just took out June low, so after taking out such a low, what should your approach be to the market? Should we wait for the daily candle to close? What's in your mind anticipating the next move or intraday? The first thing on my mind, I have had crude oil on my radar, back on my radar, for a simple reason that the average session ranges have climbed up. I'm just going to clear my throat because it is the morning, so I do apologize. See, whenever I do these, there's nobody else in the house. Like my husband is actually asleep, and I don't talk before I come on here. So you guys are the first people that I'm talking to. So I get a lot of like sort of morning voice. All right, so crude oil. It has been back on my radar because we've just climbed to 172 average session range for NYMEX. The first thought in my head is to have a look at some Some statistics that are now very kindly available from Edgeful. And just to look at some trends in August. So the first thing is to change to crude oil. Okay. I'm just going to change this to NYMEX because that's what I want to see. And then we're going to have a look at some trends as well as the intraday movement for Mondays. Price action. No, that's not what we want. We want performance trends. So that's the first thing that I look for. If you can see in August in the last 3 years tends to be a down month, right? We've had June, July that were pretty, reasonably bullish. That's because of that demand for oil and its derivatives, because of the summer mixture that is necessary throughout those months. But then I suppose in August that demand sort of dries up. And let's see if they've got a 5-year. Now 5-year gets a bit muddy because we are kind of taking in COVID into consideration, and that's what's polluting the data set here, I believe. So that's not very helpful because this is an outlier. This is a black swan event, so we don't want that. So August tends to be down. Okay, let's see what performance by weekday. So Mondays, I mean, this is just the range. Green and red streaks. Nope. Green and red days by weekday. Okay, here we go. So crude oil for NYMEX, 58% green on Mondays for the last 6 months. Now in the last 3 months, it kind of stays the same. And then if we take a longer sample size, if we take 53% for year to date, that kind of fades a little bit. So it's not that much. Yeah, that's not a very good edge. So it's we need something else. Let's see initial balance breakouts. Okay, so single break year to date about 70% almost. That stays consistent. All right, so this is something we can use for NYMEX today. So if we get a break of the initial balance, there is about 60 to 70% chance that that single break is going to stay. So that's something to take into consideration. So if we have a break out of the initial balance, maybe there is a good idea to run a continuation trade rather than looking for fades in light of potential turbulence that we may have on our hands, seeing how the equities behaved. So that's how I will be kind of approaching my crude oil. So we know that August can be short, right? And if we get that breakdown, we're already passing through the average daily range low, which is very early for London. The 24-hour daily range, it's a measure that really should only be reached during New York, during NYMEX. If it starts getting smacked this early in London, it almost certainly brings a higher volatility day. So we cannot bank on the normal days where, you have the ebb and flow, you have a nice short and then a long during NYMEX, because that's usually how it happens. Sessions like to chase each other, so that I call it a Tom and Jerry chase. Again, showing my age here, but it used to be a cartoon that was very popular when I was a kid back in the 80s, and it sometimes the cat would chase the mouse, but then sometimes the mouse would chase the cat as well. And that's kind of how I look at the sessions. So you have Asia that does something like, for example, we go massively down, And then I've lost the NQ chart. Let me find that. So Asia goes down nearly 7%. And then London kicks off and reverses that move, right? And then you also can have a situation where we go further down, but then New York opens and then they push it back up. So it's all to do with this idea that we cannot find the buyers or sellers outside of the areas that we already visited. And then a reversal has to happen. The reason why it happens is because they run out of orders, right? There's no more power behind them. So they have to go to some other levels to pick up more orders in order to push the markets in one direction or the other. Shogun beats, do you use Pro Tools? That's the, yeah. So I used to, but my favorite tool was Sonar. It used to be called Cakewalk, then they renamed it Sonar. But I've used Pro Tools quite extensively. I've used Logic. However, I have a little bit of beef with Logic because they had this amazing tool for the PC. And then Apple bought them and they became Mac only. And I cannot stand Mac computers. Sorry for those of you who love them. I don't like the monopolization that company brings to the market. Like they literally buy technologies and then they just either take them off the market or they make them into their products. And then they lock everything down. So for a time, one of the reasons why I got really annoyed with them is because the MP3s that were very popular, again, a million years ago, for like nanopods that used to be before, Spotify and smartphones and stuff. You couldn't use the same file, which technically is an MP3 file, and you couldn't have them play on another computer because it was like this whole digital rights management, DRM thing. It's like, oh, this is the Apple MP4 or MP3. It's like, it's the same bloody file. It's the same codec, same everything. Why are you locking it down? And it was a nightmare trying to get any stems for us as musicians to somebody else who, for example, had Windows, or somebody else who, had stems as WAVs. Like you just couldn't play them on it, and it really annoyed me. So over the years, I've just grown an aversion to certain Apple products. So there we go. That's out there now. Let's get back to the markets anyways. Let's move off the whole Pro Tools and stuff. Anastasio says, thank you so much for suggesting the book Markets in Profile by James Dalton last week. It's fantastic. It is fantastic. It can be a little bit hard to digest. I always felt like he wrote that book for those of us who are already traders and then just looking for experts to discuss with other experts how we can improve on the whole taking advantage of market mechanics and distribution curves and generally the auction process. But for some people, like it goes over their head. So it's a great book. It's the book that we based our indicators on. So especially the Blottek market profile, that's what it's based on. We took all the calculations and, ideas that he put forward in that book and we coded them up. So it's been completely transformative for me, and I believe for Hogue as well. So we'll see what Dalton says in his next book, because I know that some parts of it don't work as well in practice anymore. So what I've done with my Market Stalkers method, which is available on my site, I've moved it on more. So I took some other things like supply and demand on large time frames, not low time frames, and the statistical averages in times of day that I find very helpful for my particular products. And I tested out the ideas. I discarded the ones that didn't work as well maybe even faded some of the ones that he described. Like, for example, there's this thing called the 3-eye days that actually Hogue mentioned just the other day. I like to fade those. And yet, if you read the book, he says when you see that, you can safely leave the position on overnight for the continued move. But in my experience, every time I saw that kind of a day, I was fading it quite successfully. So, there are things that you should always backtest for yourself. So rather than, reading a book and going, oh, this is just, now this is my new religion sort of thing, go and test it out and see over the course of 3 months how well did that particular idea play out. That's what being a trader is all about. It's not you just sitting here and pressing buttons. It's to see whether there's merit to that, whether you can and more importantly, whether it's hindsight capital or whether it's something that you can actually see developing in real time. So my entire methodology is geared towards giving you the skills to try and sift out what is going on in real time. Now, objectivity is a huge part of that. And, the biggest issue with trading is that many people are not objective. We always have some sort of a bias. So ungluing yourself from a bias as you come to trade, that's very important. So, I struggle with that to this day. Sometimes I come to the market with a heavy bias and then I just don't flip to, to actually what's going on. And that's where journaling is very good. You have to see, your triggers, and everybody's going to have a different trigger. So, but that's the gist. So taking a methodology, seeing how well it works and whether you can take advantage of it in real time. The common critique of something like Elliott waves is that you can clearly see them hindsight capital style. But when you try and actually sift out in real time, it's near impossible to actually get an accurate entry. Maybe for like long-term investments that don't require as much accuracy and timing, that could be a strategy. But for me as an intraday trader, I need accuracy, I need precision. And then there's also the misconceptions about certain concepts. Like, for example, many people use supply and demand. I'm one of them. But I will never use supply and demand on low time frames. In fact, I expect the stop runs to happen through low time frame supply and demand zones, and then I pounce, right? So to give you an example, let's say on a 5-minute chart in NQ, we have this very nice supply zone that is from 17,920 all the way up to, let's say, 18,000, right? Well, I would actually look, if I was looking for a short in a rotational day, for example, let's say we don't get crazy movements and we just get stuck in a neutral day. That can happen after really big movements as well. So what I would be looking for, I wouldn't be looking for the supply to be reactive right at the bottom, especially not with NQ that likes to run through all sorts of areas on low time frames. So you have the nearest edge of this supply at 17,926. Some people are like, I'm going to enter there. I'm going to put my stop loss right above here. So that's a terrible trade for intraday. Terrible trade. And like 9 times out of 10, that's not going to work on NQ. So what you would be looking for is actually for the price to run through these levels, to run through the furthest edge of the supply, through the 18,000 as a nice round number, and then to get a reversal. Okay? And this is where I would jump to my low time frames to look for that big push in the opposite direction. So I'm just looking at DAX. There is a development there, so I'm going to see if I can get a trade out of that. I think we're failing the auction in DAX. All right, so let's have a look at some of the other questions. Are you going to take any trades today? Well, it looks like I'm going to do a DAX trade. at the very least. I don't know whether I'm going to be trading my live account today. We'll see. I might just stay on combines because this is a little bit too much risk, but this DAX trade is fairly smooth, so it's not like it didn't fall 7% overnight either. Okay, let's see if we can run through overnight VWAP there. So what am I looking for? All right, so I'm short DAX from 173.26. But, you know, we'll see if we can find something that Topstep already has. It will be a similar trade to NQ, because NQ is also failing its auction now. Oh my god. Like this 30-minute candle is 101 handles. That's insane. Like completely insane. Like I can't even speak. It's crazy. Yeah, it's crazy. Yeah, guys, you need to size down. Like, this is absolute insanity. Like, that's just crazy, crazy range. Ali says, Mrs. Deeyana, how much of this sell-off would you say is part of the rotation, disappointing earnings, and risk of war? In what proportions? Again, I'm not an analyst. Like, I can't tell you that. Also, this channel, you know, Topstep is about education. I cannot give you breakdowns that analysts would do because that's not what we do. You know, we are intraday traders. I can, you know, bounce an idea for like the next couple of hours that, you know, NQ is probably going to keep falling down to 176.12 at the very least, maybe even further. But how much of this is disappointing numbers, looming recession? I don't think it's that much of a threat of war, because didn't they give up on that? There was a threat of war, like, are we going to war? And then they're not. So I don't think this is that. I think what we're seeing here is a threat of recession, and everybody being mindful that the Fed didn't do anything to account for the bad numbers that we've seen, and they kind of stuck to their guns. No rate cuts, no rate cuts, no rate cuts. But now, as the numbers are getting worse and worse, they're going to have to do something, right? And this is where you get this turmoil in the markets, and everything just goes completely pear-shaped. Increasing risk for everybody. So yeah, if you are going to be trading today, either stick to like practice accounts, or if you are already a funded live trader with Topstep, consider moving into some combines, or just size down. You know, size down to control some risk. Yeah, there's no, and you know, it's Monday. The one thing that I really hate doing is just digging a huge hole on Mondays, because it just puts you on the back. It puts you on the back foot for the rest of the week. It's not a very nice feeling. And, you know, taking care of our mindset should be the priority for us. All right, so I'm just adjusting some things here. What is going on there? Okay. 26. All right. So yeah, let's have a look at gold, where the gold is moving, because like I said, I'm thinking that maybe gold could be something to look at. is attempting to go lower. Gold has smacked through a whole bunch of statistical averages, and it is currently still in that range that was established after the big jump that we had on Friday. So until that range actually goes, I would probably try to fade that if the market shows me the way. Right now, it's just going lower in a very slow manner. We're kind of creating, well, we had a poor low. We just went below it. But until this whole area is still reactive, that's an area of demand that where we were finding buyers before. So that's something to consider. When it comes to the value areas from Friday, that value area is too large to make any sort of use. And I wouldn't be surprised if we're still opening inside value. Now that tends to open up a possibility for balanced moves, so rotational day. But when the value is so large, that tends to be unreliable to me. So I just use the real-time auction and TPOs. Brian D says, so in the past you have shared the calculations you do and ranges you're looking at. Do you take into account items such as planned news, threat of war? If so, how? So whenever you have, I mean, of course you have planned news, but the issue is that you typically, like planned news, you don't know what they're going to do. So I never trade into the news. I trade the aftermath. So usually, even if you've had a massive candle as a result of the news, you get some sort of a range that gets established after the fact. So they've done their work, they've made their money, and now they're leaving us with this tiny little new range to play around with. So that's what I will be trading. So usually on very large candle days, my trades would be more akin to like a neutral strategy, just kind of rotations from that smaller range that gets established after the fact. But you cannot count on the average ranges on outlier days, because the average range implies that you have an average day, that you don't have an outlier, that you don't have an NFP release, that you don't have FOMC, that you don't have anything that can bring higher volatility day. People forget that the statistical averages like ADR or my own ASR, they are measures of volatility as well as levels. So it's not like we're coming into the ADR high, we definitely need to go short. It's like we've just had everything crashing down on us, right? And it's like all of the statistical averages for the London session have been exhausted. Now, what happens for the cash session in New York, that remains to be seen. But for now, the ADR on gold, NQ, ES, whole bunch of places, it's been smacked through. That implies we are having a larger volatility day. So those average ranges are ignored. So that carries information that is very different from let's use ADR high as a level. So I have several ways to use some of my tools in my method that kind of keeps me away from doing really stupid trades. So, things like fading the move after every average range has been exhausted, generally not a great idea. Generally not a great idea. Mihai says, is this MetaTrader? Yeah, so I use MetaTrader for all of my charting purposes. I do not like using the same platforms for my executions because I like to draw stuff. And a lot of the times when you draw stuff, you inadvertently end up in a weird sort of day where you're in a trade that you didn't want to go into. But this is my execution platform. I do use TopstepX and I also use NinjaTrader. So those are my two platforms that I use for executions. But so far today, I'm just doing analysis. And I'm just using my charting platform for that. You'll see Hogue use T4, so he uses T4 for some of his charting. Then you have Coach Jay, he uses Quant Tower. You know, you have a lot of different people who use different things. Nick Furtick uses Motive Wave. So, you know, we all have kind of our favorite charting platforms where we're pretty comfortable and we can draw things without jeopardizing any positions. All right, so let me just adjust this. Okay. All right, so gold still finding buyers in that same area. What's the time? Almost 10:30 here. So one of the things I like to look at is the bird's eye view as well. So this is where we're coming from on the daily chart. All-time highs rejected, but still having reactions from the previous area where the buyers stepped in pretty aggressively. But look at this candle. So this supply is still being reactive. This gap is due to a contract change. So I'm not sure how much stock to put into that. Now, if this whole area starts to break down, that will mean more downside for me, technically. But again, I would want to confirm that with the strength of the auction, which means that I would either want to see a failed auction for the COMEX session, or we might see a clean extension of the initial balance down for a further sustained move lower. So that's something I want to look at. But if this area is still supportive, there is a range trade there from that daily time frame view. Because so far that's where we stopped. And that's where we keep finding buyers even this London morning. It sort of does this stop run of the intraday moves, which is a market maker move. So you have the initial balance set just above the Asia high. Then we run through the Asia high, reverse, do a little pullback. And now if this holds, this could turn into a failed auction. If it doesn't, then we go lower. So I'm either looking at a failed auction long here as the highest probability trade in gold this morning. So I said first hypo, failed auction long from Friday demand. Failing that, single prints through Friday demand as a sustained auction short. So what does that mean? It means I'm looking for a decisive drop below the initial balance and then to create those single prints. Now, in order for single prints to be created at this point, we would need to close this 30-minute candle in 6 minutes all the way down below 24.60, let's say, because it's pretty close there. So if that doesn't happen, there is a very high chance of a failed auction long. And the failed auction, if we do get it, has what I like to call an intrinsic profit margin. So where do we take profits for a failed auction? At the other side of initial balance. So it actually has 200 ticks inside it as a profit margin. But I do need to see some dedicated movement here. And ideally, some kind of an engulfing somewhere. So we'll see how that works out. But yeah, that would be my trade for London. London is... on gold is not as crazy, but it still has very nice movement. So I may pop in a long trade here. But just beware that I do have another hypothesis that invalidates that first trading idea. Now, if neither of those happens, if we don't have a clear failed auction that closes pretty confidently back inside the initial balance, and we continue to sort of drift lower, but we don't get single prints, that's a no trade for me. Okay? So it's not like let's catch every move that comes our way. It's let's be very decisive this week what we want to see, because this week is going to be tricky, definitely. All right, guys. So if you have, maybe we have time for one more question, ideally, and then we can wrap it up. They're still not giving out combines. Is concerning the, yeah, that's the support issue. I don't know why they're not giving. Let's see, bought a combine Thursday, haven't received it yet. Wonder what's going on. Didn't TraderTainment have some issues? Didn't they say that they're not going to be giving out TraderTainment combines for now? Because I know TraderTainment had a complete mess up about a couple of weeks ago where nothing was working on it. So that could be a TraderTainment issue. That's maybe not a Topstep issue. Farouk says, how can we know the height of a zone while drawing a zone? Well, that's the price action. So you see where the high is and where it turned around. There's a whole bunch of videos out there on how to draw supply and demand zones. But for example, let's take into consideration this supply here. What is the height of the zone? Well, where did the market turn around? It was this candle here. So we had a stutter, a little base, couldn't advance higher, and then it turned around. So that drop, it gives you an exact size of the zone. So that means this is your high, and this is the nearest edge of the zone. So that becomes your supply. So supply and demand zones always work with basing areas. So it's like, where did the market stutter? Where did it have trouble breaking through? And therefore then caused a reversal. That's the point, the very first of the stutter, where we draw the edge, nearest edge of the zone. So similarly, if you see this area here, well, where did we stutter? Well, first of all, we started here. We couldn't go further down. And then there was an equilibrium that got resolved to the upside, creating a zone. Where is the low? Well, wherever the low of this candle was. Where is the nearest edge? So I call them the proximal edge or the demand, or conterminous line. That's my terminology, because conterminous means a common price point or commonality of some sort. And because we have the equilibrium, it means that this line, the nearest proximal edge of the demand area that I'm showing you now, it means that it had a break of that common zone, common price point to the opposite side. So it becomes an area of interest. And the earliest zone that we can get, earliest price point that we can get involved with the zone itself as a reaction. So hopefully that makes sense. I explained it a lot better. It's the morning, so explaining the drawing supply and demand zones is probably not what I'm after today. Because to teach people, I like to kind of script it out and to make sure that it's 100% clear cut. This is why courses exist. Obviously, not all courses are equal, but I've tried to break it down into complete sort of basics of what we look for. Where do we put the proximal area? Where's the distal area? So all of that you can find on the website. What is the name of the indicator that is allowing you to move the chart so smoothly? Are you talking about the Blatek backtest mode, or are you just talking about just moving the chart? Like the moving of the chart is just MetaTrader native, but if you're referring to me being able to drag the levels to any point previously. Those are my indicators. Blatek is the company, so you can check them out. Yeah, it allows me to do a quick back test on the chart, even though, you know, I still have the candles. All the levels are there. Like, for example, I can see that Tokyo had a pretty moderate upside movement in gold, and that we also opened below value. So there was a gap fill into a little value acceptance, and then pretty much traversed all the way through the value area from the previous week. But I can also see that Friday gold had a jump off a cliff into a single print move, but that was unplayable unless you were already fading it from higher up. I was actually in on a value high, and then the brackets were not triggering for some reason, so it got me. Boo. Yeah. All right. So what is the limit down in NQ overnight? I believe it's 7% now. Don't quote me on that, but look on the CME website. They will have that. They will definitely have that information. Yeah. All right, guys. So let's finish it up to date. No movement for me today in either of the available instruments on Topstep. Looking at this gold now creating a tiny single print, but then immediately joining back up. So that still puts me on to the long side in gold. But for now, I don't have a signal for it. I would like to see a failed auction before I get involved. All right, so that is it. Happy Monday. Be careful out there. It's going to be an interesting week for sure. Enjoy the fast markets later on. Don't forget that we have Dakota streaming slightly earlier these days. So he streams from 7:30 p.m. CT, and then he goes on for 90 minutes. Check it out. It's a great session. I always catch up, even though I'm always asleep when he's doing it. But I always try and catch up on his session because it's so good. And so let's keep going. Let's stay risk averse, especially this week. All eyes on the Fed and to see whether they actually come up with some unexpected moves in light of the new development. Thank you for joining me. Click like, subscribe to the Topstep channel. Let's keep this whole thing growing, and let's do this all over again tomorrow morning for the London session. I've got my t-shirt ready. Thanks for joining me. I'll see you a little bit later. Goodbye.